Hey, it is so great to be back again. And we've said this session, this bonus session, is predominantly a South African focus, but we're going to be talking about insurances in a broader sense. So it really is universal, but then we're going to get specific to some of the South African landscape. And so as you're connecting in, it is so great to have you here. And I am super excited to introduce you to a fellow FFUer, a wealth builder. And it's just been a joy for me to get to know, firstly, Natalie, which is Luke's, what would he call her? Your better half, other half.
But not me, another Natalie.
Exactly. So the amazing Natalie came in and she joined FinancialFreedom University first and then joined Luke. And then Luke has been amazing, starting, wealth building men's groups and really connecting in with his tribe. So I just want to introduce and a huge big thank you, Luke Matthews, for coming in, and we'll share Luke's contact details and you can contact him. So it's a person you can trust. He understands our language, our tribe, and all around an amazing mensch. Luke and Natalie have got two beautiful children. Yes, so thank you, Luke, for saying hell yes when we contacted you and said, come and talk insurances.
An absolute pleasure. And if you don't mind, I'll actually tell them a little story about you, if that's okay. So before I met Ann, I was a typical financial advisor and I thought I knew everything. I've been in insurance now for 20 years. Prior to that, I was in advertising and stuff like that. But when Natalie told me about Ann, I actually fought her quite hard. I thought to myself, what does Ann know? I know everything because I'm a typical male, and I also thought I was insurance, so I knew exactly what I was doing. And through that process, I actually realized, and getting involved with Ann and getting involved with this whole process really opened me up to changing the way I look at insurance and also changing the way I engage with my clients as well. So from that perspective, Ann, actually huge kudos to you, because if it wasn't for you, I might be like one of those old guys we were talking about still. So yeah. Also a little bit of information about me. I know that you guys are all over the world, but like I said, I've been in insurance for 20 years. I was in advertising for 2.5 years. I've got two beautiful kids, one of 9.5 and one of 2.5, just to make sure I get that right. I am, like I said, an insurance guy, and I'm also a regional head. I look after a division in Joburg. So that's kind of me in a nutshell.
It is so cool. And as I said, all around amazing man and father and sportsman, and you do amazing inspirational stuff, and also your own investing, diversified. I mean, the stuff that you brought in and mentor. So we are here to talk insurance. I mean, it's hard to believe I'm getting excited about this because often we can think of insurance either as a grudge purchase, or it's confusing for many people. What's the difference between investment and insurance? As we say, insurances and investments are two different things. They serve different purposes. And in this implementation week, we are diving into the realm of protection pate. We're focusing on this aspect around our wills, our things when we pop our clogs. How do we protect ourselves in while we're alive? And so I've asked Luke to come into first. We're going to be having a conversation. And also, please, in the chat, ask your questions around understanding insurance, where to go, what to do. And as if there's also specific areas in your side. So the first thing we want to just unpack is the difference between short-term and it's called long-term or life insurance. So Luke, what is the right terminology, or what would be the key areas there that people need to know?
Okay, and I'm going to use a South African context for everything that I talk about. Okay, cool. So what you've got to understand is that you're actually paying a premium that specific month for that month. Does that make sense? A lot of people think that they accrue value in their policy because they've been paying it for 5 or 6 or 7 years. Depending on the structure of the policy, if there's an investment component or whatever else it is, you are actually only paying for that month. That's actually what's happening. So you're either insuring your life, or you're insuring disability cover or dread disease cover or whatever it is, or you're insuring your car or whatever it is for that specific month. Depending on how the policy is structured, there might be other bells and whistles attached to it, But what you've got to understand, which is really important, is that you're actually only paying for that specific month. Okay. A lot of
I
people
love
say,
that.
no.
Yeah.
Oh,
Because a lot of people get hooked at me and I'll say, okay, you no longer need life insurance. You've built up your assets, whatever. And they go, oh, but Anne, I've been paying this for 20 years. So if I don't keep paying it, I'm going to get nothing back. I'm going, it's not an accumulating thing. And this is, I thank you for bringing this forward, right? It's like your subscription to your TV.
DSTV. Yeah.
It's
Yeah.
Netflix for your life.
So the problem with
I don't know
is that
what happened there.
a lot of people, so what can happen in a policy though, and this is where the insurance companies are very clever, is they will sell you a life plan. Now we're talking about life here, and they'll sell you an investment plan attached to it. Let's say you stop paying your premiums, okay? And you think you've got a cash value over here. What they'll use is this cash value to fund your life premium over a period. So what happens is that this cash value gets smaller and smaller over a period and your life plan continues. So I've met many clients where they say to me, yeah, but I've still got my life plan and I haven't been paying for it. You've been paying for it because your investment portion that was attached to that plan has been paying for it. So you think does that make sense, Kerry? I can see you've got a very cool. Okay. So what happens is that this has been attached to it. So, Anne, what we were talking about a little bit earlier, and this is really important, is you've got to try.
Don't jump ahead.
Okay. Sorry.
I just want to make sure everyone's clear. So short-term insurance is things like for your car, your house,
your household, your content, your bicycles, your watches, everything that's not got to do with blood, not got to do with pumping blood through your body. Okay, so you must be aware of that. So your cover on your house, your cover on your business, those specific things, your working costs. You might own a farm. You might have a shop with a whole bunch of stuff in it. That is primarily short-term insurance and advice around short-term. And then from a life-based perspective,
is there a term for your more life policy, anything to do with blood? So your critical illness, what would be the blanket term for that?
So there's a couple of terms for that. They call it risk cover or they'll call it life cover. I mean, that's the basic terms for it. But I know also a lot of people will say, well, risk cover is the same as life cover, but the terms are interchangeable.
Yeah,
so
because under your risk cover would include your dread disease, your critical illness, so it's not necessarily life. It's on this thing called with blood in it. I like that. We can call it blood insurance and short-term insurance.
Oh, exactly. No, that's exactly the way you can think about it.
Fantastic. So I think short-term insurance is pretty straightforward, but maybe you can give some hints, advice, suggestions. I think we cover that quite a lot in FFU. The more you can cluster it, you go through, you can cut out. It's quite a commodity-based element. There's underwriters. You can maybe, I see you frowning there, but I know a lot of the confusion that we come to is in, let's call it the blood life risk insurance. But I see you've got some points on the short term. So what do you want to say on that?
So Anne, what I would do on your short-term insurance is I would cost it out every single year. That's what I would do. And I would cost it out to multiple companies. It doesn't mean you have to change. Okay. It just means that you can actually stay. You can actually say, okay, well, listen, the one that I've got works well for me. And the nice thing also is that when you cost it out, your competitors will tell you, I don't want to swear on this, but your competitors will tell you how bad. Your competitors will tell you how crap your current insurance is. And the cool thing about that is that you actually want to find out what you've got and what you don't have. So let's say, for example, from a South African context, you might go onto hippo.com and you might have a look at your car and whatever else it is, but then you might know that you've got a short-term brokerage up the road and they're advertising. You can just phone up that short-term brokerage and say, hey, listen, this is what I've got. Can you give me a costing on it? And the nice thing about that is that from a costing-based perspective, especially in South Africa and I mean, wherever you are in the world, you want to see if you can save a bit of cash. That's something that a lot of people are focused on right now. But the nice thing about this is that your short-term insurance and your life cover increases every single year, okay? And companies want your business. So for them, what they're going to do is they're going to compete for your business. Sorry, my phone's busy dropping. They're going to
wanted to go walkabout.
Look at the roof soon. So they're going to compete for your business. And the nice thing about having that is that having that competition means that you're able to have an informed decision around what your short-term insurance looks like. So I'll use Discovery, for example. Discovery short-term insurance is good. It's actually one of the best. It's one of the best around. But the problem with the Discovery short-term insurance is that it's very expensive. So then you might say, okay, well, listen, let's have a look at momentum and see what momentum can give me. And then you actually want your advisor to work for you. You don't want it to be the other way around. You actually want the advisor to then say, this is what Discovery will do. This is what Momentum will do. This is what Sunlam will do. This is what Santam will do. This is what Echelon will do from a short-term based perspective. Because every single one of these companies have firstly got different underwriters, okay? They've got reassurers as well that they're using that are similar, but sometimes can be different. But they've also got different ways in regards to, let's say, for hypothetically, you might have a BMW 325. This company might insure you differently opposed to another company. So let's say, for example, and I'll use Discovery again. If any of you guys are on Discovery and you drive badly, you will know that Discovery will penalize you for driving badly because there's a chip on your car. Now, other insurers don't do that. You know, so from a cost-based perspective, you want to make sure that in January, you kind of look at your costs again. It's a great exercise to do across everything. And I do it. I'm in insurance and I do it every single year.
So that's fantastic. So short term, as I say, it's a commodity. It's your tin of baked beans. It's whatever. You just go in. Who's going to give you the best quality for a price? And I think it is also good practice because most people it's one of those things they just leave. Yeah. It ticks over and the price and the escalations are happening. And the insurance products love that because they can just let the price go up. Whereas if you actually contact your insurer and say, hey, get me a better quote, it's amazing what you can save in this area.
Yeah, you know, and there are some people, and I love that there was a quote there, I hate Discovery. But the weird thing about it is a lot of people that love Discovery. And the reason they love Discovery is because they work the program. And Discovery, for all intents and purposes, is a round circle. It's like a football. You have to work every single piece of it. The cool thing about it, there's other insurance companies that don't work like that. And you can block build, which is great. And I love the ability to block build because I can move my stuff around. But because I've been in insurance for 20 years, I'm very, very aware of the fact that if I'm not costing my insurance out every single year from a short-term perspective and looking at what they cover and how they cover and really getting involved for half a day or whatever it is, just to find out what's going on, it really helps from a, I'm going to go say this word again, a costing perspective, because most of you people pay school fees. And I know with myself and my wife, we pay school fees. And if we can shave off 200 or 300 or 400 Rand and utilize that capital in an investment or school fees or whatever else it is, it all helps. But, and you're spot on, people are lazy. And the problem with being lazy is you're just like, oh, well, it'll just go up or see what happens.
I think it's a combination. And if you just don't realize that that's how it works, and that's why, we talk about having our mega money date. We're saying I always do it in December, and this big recosting exercise. It's a low hanging fruit way to keep your costs down. So short-term insurance. So let's go to risk. And this, for a lot of people will go, okay, Anne said, I've looked, do I need life insurance or not? I understand what its role is. It's about risk cover. It's not an investment. It's when I'm building up my assets, if I've got once I've got my assets to a certain type that can pay for my dependents, true dependents, not the hangers-ons that like handouts, or, then I don't need life insurance. And if I don't have any dependents, the role of that. And so they'll go, okay, great. And they'll contact their financial advisor, or Discovery will go, oh, no, this is an investment. It's a product. So let's just start navigating. Somebody now says, yes, they know they want and they need life insurance, and they want term life insurance without the bundle. So what again is the difference languaging between a whole life product versus a term? And what is also the difference between a pure life versus term, if there is any difference?
Okay, well, you're going to have to steer me on this because there's a lot of questions on there, but I just want to go back to what you said. I love the fact that you use the word need. I think that's the weird thing about insurance is that when you can get sold quite easily. Okay. And I've been doing this for 20 years. I've met a lot of guys who are very good at selling. You have to ask yourself, why are you buying this insurance? Why am I buying it? And then what you've got to do is, once you've thought out why you're buying it, you've got to have a look at your debt. So let's say, for example, and we'll get into term cover and those kind of things a little bit later, but and so let's say, let's spitball. Let's pick on Natalie, if that's okay. Natalie, can I pick on you? Okay. So let's say Natalie has got debt of 5 million rand. Okay. And Natalie's got 2 kids, and they are both 2.5, and schooling costs money. And let's say there's no partner. There's a whole bunch of things that when the light goes out at night that you think about. Lots of things that you think about at night. And you roll them around in your head a lot. Okay. Yes, you can pick on me. Thank you. I don't know if it's you. It's another name. So from that perspective, is that what you've got to do is you've got to say, well, why am I actually buying this insurance? What's the reason for me buying this insurance? What's the rationale behind it? And I love what you said, Anne. Is the insurance there to enrich family? Is the insurance there to enrich someone? I mean, that term enrichment, I think, is a great thing, because what's the main reason to have the cover? And I love what you say, Anne. I mean, I was listening to Gareth Cliff talk the other day. He says, you only want to give as much as you possibly can. And I think from that perspective, that's where insurance comes in. If you don't understand what the amount of debt is and why you're buying this and what's the intention of it, then why do you have the cover? So if there's a need for it, that's the thing. If you want insurance, it's a very different thing. If you want insurance,
if you want insurance, then you don't understand what it is. As you said, it comes back to
that's exactly
that you're covering for a month. It's not a want, and it's not a gift. It's not, as I say, it's not death. It's not the death lottery that the family, you popped your clogs and now they see what they're going to get have they got the numbers? That's not its point.
So from that perspective, you've got to ask yourself, when you're buying and when you're signing on that line, you have to ask yourself, why am I buying this insurance? Is it because of a need? Is there something that I've done here? Have I done my numbers on it? Or is it a want? Okay. Then in regards to your question around term cover and whole of life cover, in preparation for this meeting, I had a conversation with a lot of people around term and whole. Okay. I am not an advocate of term cover. I don't like term cover. And the reason I don't like term cover is because it's defined for a specific term, and it can be costly or it can be cheap, depending on who you're going with. Specific providers provide term cover. Okay, so let's say, for example, what is term cover? To cover a bond specifically. So you've got a 5-year bond or a 10-year bond or a 15 or a 20-year bond. Okay, so let's say you are 35, you take out term cover to end at the age of 55, and on that term policy, you've got disability, dread, and income protection. When that term ends, okay, what you're entitled to do and you're allowed to do, you can have it end at that specific time because it's run its course, and that's why you put it in place. Or what you can then do is you could then say, I'd like this policy to continue, okay? What happens at that specific point is they recost your policy, okay? You've got to be careful. Now, let's say, for example, the term was for 20 million rand. It was over a 20-year period. After that, you are also allowed to then say, well, I don't need 20, I need 5. Let's recost it like that. Because now you're older, there might be a couple more creaks, there might be a couple more things that have gone wrong. You never know what's happened. And they look at you and then say, oh, you're a hazard. So we're going to or you might have had cancer, whatever else it is. They're going to say, no, we're going to look at you differently. So you've got to be aware of those specific things. Term cover, depending on who you're talking to from a cost-based perspective, will be costed out as per the reassurers. It's very difficult to find out which one's going to be cheap and which one's not. So then you might then say, okay, well, listen, let me look at whole life cover. And whole life cover.
So before we go to that, I really want to just make sure everyone's saying term means for a period of time for amount of money. And it might have escalation in it or it might not. So we'll come back. And this is such fun because this is where Luke and I fundamentally disagree. And that's what's so important. We can thrash it out. But we just understand that's for the period. Okay, understanding there's a risk you want to cover, why you need life insurance and for what its purpose is for a period of time and for a period of money. Cool. So I just want to make sure everybody's clear on what we're talking about there.
So, and the reason I'm not a big fan of term cover for me is because the hassle comes in right at the end.
Yeah.
So let's say, for example, there's kids or whatever else it is, or something might have changed. You then a little bit older, and you might then say, okay, well, I need to tweak, and the costs become a lot higher.
Let's say, why do I love term? Because in the context of you being your own wealth chef, you going, I'm taking responsibility for my financial well-being, and I'm investing, I'm clearing my debt, I'm doing my entire wealth ecosystem, I'm clearing debt, I'm building my assets, and I understand that insurance risk insurance, life insurance, is to cover the gap when I have dependents. Every time I stick my finger up, it gives me fireworks. This is hysterical. This is such fun. I don't know whether I'll be able to get it going again. I'm going to have to put my hand down. So it's to cover that. Do you have dependents, and for a period of time? Because, so Luke, yes, there's a risk that if you don't do the other things, the whole point is to build up your assets so you don't need insurance, because insurance is filling a gap. So there's a period of time to say, hey, Natalie's got her 2.5 kids for 2.5 years and all of that side. There's a point at your role in life is to go, are you also building your assets? Are you getting rid of your debt? And as a parent, are you ensuring that those kids fly the nest? Because in that 20-year period or 25-year, if you factor that in, and so that's the fact of working out what you need and for how long. But I do have a problem to say, well, we end up always buying almost crutches for ourselves. So we do want to overextend. So now we're getting the detail into the time period, the term that you're going to have it. But if you are not going to do your other wealth creation activities, and if you're seeing life insurance as a financial crutch, I have a problem with that as a kind of an understanding, because it's not a good financial crutch. You should be building assets. So I fully get the repricing. My point is, you shouldn't be repricing, because if you've done your other stuff. But yes, there's an element in there.
So Anne, I love what you just said, and I think it's great, because for me, there's a distinction in my head for people who have regrets and people who don't have regrets. Okay, and that's a difference. I mean, Natalie and myself, not this Natalie, my wife, Natalie and myself, we talk about this a lot. Now, the weird thing about this is that what you could do, and the reason why I like whole of life cover, is whole of life cover is normally a lot cheaper than term cover. Okay. And the cool thing about life cover, let's go back to what we spoke about around the beginning, is that you're insuring your life for that specific month. Okay. So somewhere along the line, you are able to stop that life cover. So I was having a conversation with my Momentum broker consultant this morning, actually, about this specifically. And I said to him, in your opinion, what's better? Is term cover better, or is whole of life cover better? And he said, Luke, what you've got to understand is that when you take term cover, you're actually just taking the term and you're making the term shorter. So if you make the term shorter, you're increasing the cost. Whereas if you keep the cover whole of life, and this is why the cost comparison are so important to do with your financial advisor, you've got to do these costs, is that the term cover might be more expensive than the whole of life cover. Now, the weird thing about whole of life cover is that you buy that cover for that specific need. So let's say, Anne, for 2 examples, you might have an individual who says, I want term cover for 20 years because by then my kids are going to go. Now, the premium on that might be higher. But then you have an individual who says, well, I need exactly the same for 20 years and I'll stop it after 20 years because that's the intention. But the premium on that might be lower because you've done your sums on this. So from that perspective, you then say to your financial advisor, okay, listen, which one's more, I don't want to use the word cheap, but which one is more cheaper?
Cost effective.
Which one's going to get my buck? And that's where it comes in, because from a term cover perspective, let's say, for example, and you've got a business, okay? And on that business, the business has got a 20-year loan on that business. You might then say, I need term cover for that specific business because there's business partners involved in it. And the business is going to own, the business is going to pay for it. That might be a good thing. Or you might have a bond, or you might have whatever else it is. So I understand term cover for that perspective, but life cover also, that you've got to do your numbers on that.
So Luke, so let's talk about whole life. So for many people end up getting sold a whole life product, which they are not able to terminate. And so, well, as you say, either they locked, a lot of products are sold with, you're locked into these premiums, these policies, especially these combined insurance life product, disgusting things that you get. So let's talk about whole life, and how do you get a clean whole life?
I love what you said, and I love that you said that. So I've never heard of a policy that you are locked into. Maybe a term policy you might potentially be locked into, but if you buy a house, you're locked into that house. You buy a car, you're locked into that house. You are able to, in this country, cancel any policy you want to. And if you want to cancel it, you just go to your bank and you say, listen, I don't want them to debit my account anymore. Thank you very much. Okay. You might get locked into a specific policy that might be an investment policy. So from that perspective, there's penalties on that one. But yeah, so just
But I
in
think
regards to
that's
that.
what then happens. A lot of people get sold these bundled things.
Yes.
And so they get locked in. They might legally be allowed to cancel the insurance, the risk cover component, but they are told that they've been locked into a contract under this investment, under this bundled, the all Phoenix Rising, great life, feel wonderful policy.
It sounds like you're talking about a company that just went bang last week. So let's go back to this.
So let's go back to whole life and the pricing of it, and the separating this investment, the savings component, whatever they sometimes call it, versus just what you're needing.
Okay, so let's talk about Discovery. Okay, we'll talk about Discovery. Discovery is a soccer ball. Okay, and if you have a look at Discovery, what Discovery does is it's not Discovery, it's actually Vitality that they sell. So Vitality, it will reward you on the bank, on the short term, on the medical, on the investment, on the life, on the everything. And they want you to integrate. The word there is integrate. If you integrate, you're really good at it and you work yourself up the tiers on that, you get a whole bunch of cashbacks and bonuses, which is great.
Yeah, so you become a slave, you become a puppet to them.
You become an advocate, okay? Most insurances are like Lego, okay? So think of Lego. You're able to put the Lego together. You can pull it to pieces. You can put it back. You can do what you like with it. Now, you have to ask yourself, okay, am I the type of person, like I love the word you used there, am I a slave to my insurance? And am I happy being a slave to my insurance? And am I happy with all these benefits and all these rewards that are coming through? Or do I want simplicity, okay? And the weird thing about that is it's almost personal. It's person specific. Every single person is going to say, well, I want something that's going to give me like a benefit, or I want something that says what it does in the box. Okay. What it says in the box is your Sunlands, your Liberties, your Old Mutuals. Momentum to a point. Momentum's got a rewards program that comes in there as well. Sunlam as well, but you don't need to use it in Discovery. So it's kind of going up the tier. So what you want is you actually want to get hold of an independent financial advisor. And can we go into independent versus non-independent financial advisor now?
Yes, absolutely. And welcome. Thanks, Kerry, for putting the question in, because I think this is really important. There's an assumption that people know what's available to them. So we'll say people are choosing, am I a benefit kind of person, or am I a Lego simplicity person? Most people are not. That's not communicated to them. They're sold these products on fear. And if you're a nice mother, if you're a nice husband, then you'll do this for the people you love, kind of bullshit, instead of cleanly what's going on there. So I'm being a bit extreme, but I'm not actually being extreme. It is an industry that relies on fear.
Yeah, it does.
And sells on fear and greed. So let's talk about the two different kinds of people that you can buy these things from.
Okay, so I'll tell you a story about me quickly. So like I said, I've been doing this for 20 years, and I was a Liberty advisor, and only a Liberty advisor, for about 11, 12 years. And the way I generated my revenue was by peddling Liberty products. So I would go and I'd have to sell a Liberty product. And the weird thing about that, you're on the money. If you don't do this and however it works, I've only got Liberty that I can sell you. And insurance guys are taught to sell unfair. It is, because as a mom or as a business owner, whatever, you've got these things that keep you up at night. So it's quite weird. The person would buy the product, but then they'd also buy you to a point. Okay. When you move away from that and you become an independent broker will give you a cost comparison across multiple tiers and multiple platforms and multiple things. The sale that I go through now is a lot easier because, and I'll talk about me as an advisor, is I would have to sell a specific product to get paid the commission on that specific product. So I was forced to sell that specific product. Okay. And it's hard because you don't buy that product from me, then I've got to go to the next one and the next one and the next one. Okay. Versus where I am right now, I'm an independent individual. I can go and I can sit down with Anne. I can say, Anne, what would you like? And Anne would say to me, well, listen, Luke, this is the type of individual I am. This is the way I feel about my cover. I'm looking for specific term cover. I'm looking, whatever it is. It gives me the opportunity now from a broker-based perspective to give a cost comparison across the board. Okay. And the nice thing about that is that I sell on price. I sell on price and benefit. That's what I look at. Sorry, just turning that off. I sell on price and I sell on benefit now. And the reason I do that is because at the end of the day, whatever Momentum or Sanlam or Discovery or Hollard or FMI or whatever do, they do very similar things. They do very similar things, but their costings are very, very different. Their costings are very, very different from a term-based perspective, and their costings are very, very different from a whole life perspective. And now, Anne, here's something which is really important, okay? Insurance companies go through peaks and troughs. And when they go through these peaks and troughs, is what they're trying to do is they're trying to clean up their books, okay? So all of a sudden, Discovery's costings will be really, really good. 6 months later, they'll be terrible. Because what they've done is they try to get more people on their book over here, and then what they try to do is they try to get less people on. Liberty's doing the same thing at the same time. Momentum's doing the same thing at the same time. And what happens through that process is that Liberty might be expensive now, but in 6 months' time or whatever, it'll be cheaper. Okay, so you move through these cycles in regards to the way that the companies are trying to clean up their books, and that's why it's so important to have a look at your insurance once a year. I'm not saying that you have to change your insurance. You can stay with Liberty, or you can stay with Discovery, you can stay with Momentum. If you like your financial advisor, then stay with the financial advisor, okay? And if you trust that financial advisor, then stay with him. But the weird thing about this is that actually doing those cost comparisons is really important. So what I found, Anne, which is very interesting, is that about a year and a half ago, you couldn't beat Discovery. You just couldn't. And now what's happened now is Discovery's being.
Are we talking about for risk?
We're talking about for risk, and we're talking about
risk,
term.
Yeah. So we're not talking about short term. Yeah.
No, we're talking about risk now.
Yeah. Risk,
so, or risk cover. Okay. So what you want to actually do is you want to move through those peaks and troughs. The problem that you've got, and I'm not taking anything away from an independent guy, from a guy who's, let me not try that again. I'm not taking anything away from a tied individual who's tied to a specific product line. But that individual can't give you a comprehensive costing, okay?
Yeah.
He might or she might have to go and outsource and get those costs, okay? They might have to go and do that so that they can do a comparison for you. But at the end of the day, you've got to understand that that individual, when they're selling to you, they need you to buy from them because they need to feed their family as well and pay their bills. It's really important that. Okay, so you've got to be aware of those specific things. So I think from that perspective, Anne, is that what you want to try and do, okay, is every single year if you can, okay, even if it's term cover for a specific term, okay, you don't want to get out of that term cover because it's there for a specific term, okay, it's defined for a specific term, but you want to do cost comparisons to find out if what you've got is worth it, okay. That's really, really important. You want to do the exercise.
That's really key because, I've always sort of, again, I haven't held risk insurance for years and years and years because essentially I've made sure that I self-insure, buy my assets. That's, for me, part of the key part. So short-term, different. So that's really interesting. And so in terms of your whole life and your risk products, what would be I guess then you've got to look at the implication of shifting, but I suppose it should be no different. If you can cancel one, start another, but you might have a different pricing point.
No, so here is where the catch comes in, especially on risk. Okay, so the catch comes in on risk. If you're healthy and you've got the cover and something happens, you don't want to change the cover. Okay, so let's say, for example, I'm healthy and everything's cool with me, and then all of a sudden I pick up cancer, okay? I do not want to change my cover. And the reason I don't want to change my cover is because that specific thing is a trigger event. So let's say, for example, you're a healthy individual, and then you start costing everything out. If you've been underwritten and there's a loading and there's an exclusion on your current policy, okay, you've got to be aware of those specific things because you'll have to disclose them to your new product provider. Your new product provider could load you or exclude you or not even take you on as a client, okay? So what you want to do, and this is a very big distinction I'm making over here, is you want to do the comparisons, okay? But you don't want to move if there's a problem, okay? And I've seen this happen multiple times. I've seen this happen multiple times where an advisor comes along, sells you a product, he hasn't done his due diligence on what you had, and then all of a sudden, all the benefits that you had over here that you were loaded on or excluded or whatever else it is, you can't get them on the new policy. So now all of a sudden, if you claim on this new policy,
some people there hasn't been a disclosure, and then that comes out later.
So, and it's actually got a lot better. So if I take you back 15 years ago, disclosures were you could get away with quite a bit, but now they know everything about you because they've got your medical records.
I'm saying
So,
they could, inadvertently exclude you if it hasn't been a full disclosure from your side.
So yeah, exactly. And so here's another interesting story for you. Actually, a wealth builder that used to be on your program. I met her through you. She had cover with Liberty Life, and on that cover there were specific exclusions that she had on that life cover. She then approached me and she said, "Luke, can you do a comparison for me?" We did the comparison, and we disclosed everything to the new provider, everything. And they took her on without even asking a question. So I was shocked because I thought to myself, no, we're going to go from bad to worse here. But what happened is we actually went from bad to better. And she was very, very happy with that specific cover. And that's also something you've got to be aware of, is that the insurance companies, even though they might seem like doom and gloom, are also trying their best to get better and better as well. So from that perspective, you might then, before you jump from ship A to ship B, make sure that when you're jumping, everything is in place and everything is being discussed. You don't want to jump from point A to point B without knowing what you're jumping to. And I love what you were saying a little bit earlier. This is where, and I am allowed to swear marginally on this, hey? This is where the shit's going. The shits don't tell you. So what happens is I'm very excited to get the cover, and I'm not going to tell you that you're going to be excluded or loaded or whatever else it is. You've got to make sure that when you're going from point A to point B, that before that actually happens from point A to point B, that you've checked everything. So, I mean, and that's why I'm going to go back to it. From a costing-based perspective, it's great to do the costings, but you also want to make sure that before you move, that you've checked everything.
So, Luke, I think key things going back here, understanding the difference between short and risk insurance / life. Now coming in, generally, you want to have an independent broker, not a tied, because then you can understand the pricing. You want to be doing your costing / repricing every year. Now, with these different bundled things, and I'm not a Discovery fan at all. I'm not a football. I'm not interested in being anybody's puppet and playing around trying to get X points or this points. It's just ridiculous. Like, why buy a fucking new pair of sneakers every year just because I'm going to get, let's see if I can get Zoom to redo its fireworks. Because in a way, that was showing what people end up being, these crazy puppets just to get their stupid points. I mean, like, no, buy what you need to buy is my view. So we've got a great question from Kerry. Where we get these bundled together. So you've got some life, you've got some income protection, you've got some dread disease, you've got this, that, next thing. But the problem also with that is, so if a person no longer needs life insurance because they've got no dependents, they've got no debt, they've done what Anne told them to do, they've built up juicy assets, but they might still want some income protection as part of their cash safety net instead of holding it in cash, or they might want dread disease or that kind of thing. How do they come in with their Lego bits? Is that just coming to the likes of you and saying, this is what I'm wanting, put together a bundle for me, versus these pre-packaged stuff?
So let's just make a distinction on that. So when I talk about risk cover in my head and your advisor's head will include disability, dread, income protection, and life. It's all together. It's considered one product.
No, it's well, does it need to be considered one product? Because that's my point. They're different things. Yeah, they're not one product. They're to do with the blood versus the bricks.
But they're different line items. So let's say, for example, a risk product might only have disability on it.
Yes.
Or a risk might only have dread disease on it. Or a risk product might only have income protection on it. Or it might only have life cover on it. Or it might have all four, or it might have three, or it might have two, or it might have an investment attached to it, or it might have a whole bunch of things. So what you've got to be aware of is, as you get older, and I'm going to pick on you, okay? Because I see this a lot. I
don't get older. Marvelous. You just use more filters on your Zoom.
So I still remember. No, I won't get up there. So what happens, especially with older people, is they have this huge life cover in the beginning, and they've got teeny tiny disability and dread. And what should happen over a period of time is your life cover should decrease. It should decrease because the debt that you've got gets less and less and less and less. When you die, you're dead. I mean, you can leave it to your kids and whatever else it is, but the life portion is there specifically for kids and debt. That's what it's there for. But what happens is that as you decrease over here, you don't look at your disability and your dread. The hassle with that is that as you get older, guess what happens? Your disability and your dread becomes a bit more of a priority for you. Because one of the other things that also starts increasing is your medical aid. Okay. Now, this is a terrible thing about medical aid, is that if you can't pay your medical aid and if you're at a specific hospital, I'll kick you out after a month because you haven't paid for it. Tough tacky, off you go. You can go to Joburg Gen, or you can go up the road, or whatever else it is. You're not paying for your medical aid, so off you go. If you pick up a cancer or a heart attack or I don't know, whatever it is, you need to make sure that the disability that you've got in place or the dread disease that you've got in place is looking after you as well. So let's say, for example, you're a granny of 75 and you've got life cover of 20 million, but your disability and your dread is 500,000. Okay. You're going to be paying an arm and a leg for that cover because the life cover is so big. So you might then say, well, I don't need this life cover. Let me get rid of this life cover, or let me terminate this life cover, or let me make this life cover really, really small, but have the ability to increase my disability and my dread. Now, from a cost-based perspective, let's go to those line items. Your life cover is normally the cheapest line item on that. Okay. Disability and dread disease cover are more expensive. Income protection also to a point. Now, here also is another catch that you've got to be aware of. Rating categories. Do you smoke? How old are you? What's your earnings? What's your occupation? All these specific things they rate you on and rank you accordingly. So let's say, Anne, you and I are exactly the same person, but I work at Pick and Pay, okay? From an earnings-based perspective and an education-based perspective, we're exactly the same person on paper from what we look like, but your rating and ranking category will be a lot higher than mine. So my premium will be higher than yours, if that makes sense, what I've just said, because you are less of a risk and less of a liability for exactly the same thing. So what you've also got to be aware of is that even though you want your life cover to come down over a period, and that's why it's really important to cost these things out. Your life cover is going to come down, your disability and your dread disease as you get older. Okay, because I mean, if I had to ask people in this room, do you have parents who are sickly? 9 times out of 10, there are people in this room who've got parents who are sickly. Okay, who's busy funding their medical aid and who's looking after them in old age? 9 times out of 10, it's the person on the screen. Okay, so what you've got to be aware of, you've got to say to yourself, well, where can I free up cash? What do I need to tweak? How does it work? Now, if I go to my mom and I say to my mom, let's decrease your life cover, I know what she'll say to me. She'll say, no, I want your kids to have something when I die. But I also then say to my mom, well, mom, I don't want you to be a liability on me, but let's make sure that your medical aid, your disability, and your dread disease cover is in place. And that's where you can either, and this is where it also gets really confusing, okay, is you can have non-accelerated benefits or accelerated benefits, okay? Think of 3 glasses like this, one here, and one here, okay? And let's say there's a straw at the bottom of these glasses, okay? If I were to take these 3 glasses and put them over here and fill up this glass, these other 2 glasses over here are going to fill up as well, hey? They will, they'll fill up. Okay, this is the life portion. There's disability over here and dread disease over here. If I were to drink water out of this portion over here, what's going to happen to these other glasses? They're going to decrease, hey?
Called good old Archimedes.
Natalie, you shouldn't drink Monsters, they're bad for you. No, I'm joking. Okay, so what happens is that these two
insurance premiums just go.
These two will decrease. These are called accelerated benefits. Accelerated benefits are more cheap than non-accelerated benefits. Let's take the straws away at the bottom over here. Straws are gone. This is a separate glass and this is a separate glass. I'm able to sell you a separate glass. I'm able to sell you a separate glass. I'm able to sell you a separate glass based on the benefits. If, however, I was going to sell you accelerated benefits, I would have to make sure that there is a portion of life cover attached to the disability and the dread disease cover. Does that make sense, what I've just said? Okay, good. Okay. So what happens is that you might then say to your financial advisor, listen, dude, I want accelerated benefits, accelerated off the life cover on my disability and dread disease. What do they do to my premium? He or she will look at you and say, oh, I might be dealing with a different person over here. Versus sell me non-accelerated benefits. You will see it in the premium. The premium on non-accelerated benefits will be more versus accelerated benefits. Does that make sense?
It does, absolutely. But I'm going to come right back to your side. At the end of the day, what I'm trying to create, and every wealth builder here, is a savvy individual who's not sitting at 75 without assets to pay for their dread disease and stuff, and having to play the lottery of an insurance industry. And this is the thing, how do savvy individuals who getting rid of their debt, building up their assets to be financially free, say, okay, I understand that risk is meant to be risk. It should not be, it's not an investment. It's not a side. It's for these extreme events. How do I price those effectively? And so when you consider in that, a savvy individual who's investing, building up net worth, got their income being provided by their assets, they've done what Anne lectured them to do, they're in the side, but they understand the risk. So in that case, the difference between the non-accelerated, getting the separate glasses versus going, oh, well, I can get all the stuff, but I'm getting a whole lot of shit that I don't actually need.
Totally. No, totally. So, Anne, I love what you've just said, and that's where the need versus the want comes in. So Anne mentioned a little bit earlier, we have a men's group. There's about 10 of us in that men's group. And it was formed because of Anne. She's absolutely amazing. But we often talk about, we are acolytes of Anne. We are acolytes of Anne. I call us the apostles of Anne in regards to the way we do specific things and how we do it. Because what happens is we sit in a men's group and then we go off piste. We kind of go off the reservation, and then one of us will say, no, Anne didn't say that. Anne said keep it simple. Make sure that it's simple, and you make sure that from an investment-based perspective, and I don't know if you remember you actually drawing that triangle. Do you remember the triangle you drew in regards to where your assets are split in regards to 2.5 into crypto and between 5 and 10 in easy equities or Satrix and stuff like that? I use that in my planning now with a lot of my clients. And the main objective is to make sure, and I love what you've said, life cover or risk and short-term cover is a need. It's not a want, it's a need. What do I need to make sure is covered? And I don't need more than is required. Okay? Your company will give you more.
And if I'm provided for that need in the way that I should, in a far more generative way, then I also don't need it. So I'm just going to come back to, somebody comes to you, Luke, and says, okay, I need these components. I understand accelerated, non-accelerated, sort of. Where I come back in, this is my gap. And I quite like that word. It's not gap cover as in medical aid gap, but how? And this is where Kerry's coming and says she's got a policy which is life insurance, income protection, disability, all of that together. How do they? What are the questions they ask the likes of you to say? Give me a pricing of bundled, unbundled, or accelerated, non-accelerated, so they can make an informed decision and say how much they need what.
So, Anne, a question for you. Do you think insurance is an emotional purchase or a logical purchase?
So I want people to make it as a logical purchase, but it's sold to people as a emotional insurance. And that is the challenge. I say we need to protect our money from us because we are big bags of emotional stuff, which does not make good financial decisions. So if you can understand what this is, it is sold as an emotional thing, but it shouldn't. It's baked fucking beans.
And I think the weird thing about this is that when you talk to a person about insurance, and I'm going to go back to that scenario about what happens at night when you're in your bed by yourself with money running around your head. You make illogical, emotive decisions about the life cover and about if I'm dead, what will they say at my funeral? And I've got to make sure I provide for my children and all these crazy, weird things. And for me and Natalie, I mean, we speak about this a lot in regards to money. We often say to ourselves, well, how do we generate assets that generate wealth over and above the life cover? Because I mean, I work in insurance, but I think from that perspective, just come back to your question around Kerry, is that Kerry needs to marry. She needs to marry the emotive decision-making and the logical decision-making, and be aware of the fact that no one's going to judge her on her decision-making, on what she does.
I don't think she is. So, Luke, I'm going to come back and ask the question because you're not answering this question to me. Who does Kerry go to and say, I need this, this, and this? Give me a clean pricing. And don't ask me to worry about what I'm waking up at 3 a.m. I appreciate you come from that does it, but she's going, I'm doing that work. I'll worry about my emotions. She's now come, she's been here. She said, okay, I want to come to someone, give me a clean pricing and tell me what it is that I'm doing so I can make an informed decision, not an emotional decision. And how does she what does she ask for to get a clean pricing between a bundled product and an unbundled? So she can buy the glass separately, so she can understand that. What does she ask for? Because this is the problem. Many people go to the insurance financial advisor and they will just keep being told the same thing over and over instead of going, here's your pricing. Or your costing.
Carrie, the person on my screen, Carrie Ann.
Yeah.
Okay, different Carrie Ann.
No,
okay,
two different ones. There's Carrie Laws. Look in the chat.
So I think the person that she's got to find is she's got to find someone that she trusts. And
but what does she ask for? So Luke, what I'm literally asking you, what does she say? Does she say, give me a costing for a non-accelerated and accelerated, or a bundled, unbundled, for this versus that? I'm asking the language. You're so familiar with this world, you know the language. She's contacting someone, say, are you an independent broker? And can you provide me costings on this, this, and this? Give me the language.
Are you an independent broker? Don't sell me. This is what I want.
And what is she saying she wants? She wants a costing on, is it called accelerated, non-accelerated, bundled, unbundled? What is she asking for costings on?
So I would ask for costings on both. And so let's say,
but I'm asking you to give us the language.
So
what is she asking for?
Because I mean, I don't know Carrie's situation, but the thing that I would
don't
ask
worry, we won't hold you to it.
Thank you, please don't. So, and I'm glad this is recorded. So what she would do is she would then go and she would say to the individual that she's dealing with, I have debt, hypothetically, of $1 million. I've got debt of $1 million. And let's say, for example, Carrie comes from a family where there is dread disease. Okay. Carrie also works at a company. Now, this is another one where a company might cover the 500,000 from a group life perspective. Okay. Now, and I'm making this a little bit more complex because your company's also got group life benefits as well that they give you on disability, dread, income protection, all those kind of things. You've got to know what your company is giving you. So the first port of call I would go to, and first port, is go and get your group life benefits from your company. Your company should be giving you those every single year. Once you've got those, you can then say, okay, cool. I know that I need R1 million worth of life cover. I need R1 million worth of disability, and I need R1 million worth of dread disease to cover. And I need to cover my salary. That's my need. That's my need, not my want. That's my need.
Because I haven't done anything yet that Anne's told me is a good investor.
Yeah. Think of
but
it
once I have, I don't need those things.
No. Okay. But think of it as two puzzle pieces that are inflatable. Okay. Two puzzle pieces that fit together that are inflatable. Okay. This one can be inflated to a specific level, but you need it up here. Okay. So you need to make sure that the puzzle piece that you buy from your insurance guy or girl covers those specific debts. So you would go and say to your financial advisor, I need the following because here are my group life benefits. I need 500,000 rands worth of life cover. I need 500,000 rands worth of disability. I need 500,000 rands worth of dread. I don't need income protection because my company is already providing it to me. Okay. Give me that costing. I would like non-accelerated benefits first. I would like accelerated benefits second. That's what I would like. Give me a costing on those two. And then from that perspective, the conversation then can then continue. But you've got to be aware, and also if you move companies, then those benefits fall away.
Yeah, I mean, we cover that a lot in FFU, and you've got to first stack up. Now, for a lot of FFUers inside they're self-employed, they've got their own businesses and elements, but you've got to go first. What do I either get provided for by, if you're salaried employed by your company? So you're bringing those together and you're always going, what's that gap? That's brilliant. And so what would they then look for in terms of what's come back? What are the kind of things they should look at between the accelerated and non-accelerated?
So benefits, the funny thing about this is that you've got to be aware of the fact that, let's say, for example, you've got 500 disability, 500 dread, and 500 life. And that's accelerated versus the 500, 500 is non-accelerated. If you utilize 500 over here, okay, the funds in the life are going to be depleted. So you can't claim anything on anything, okay, depending on how the structure is working. If you've got 500, 500, 500 over here from a non-accelerated perspective, the funds are not, so you use 500 of dread disease, you still got 500 life and 500 disability. You've got to be aware of those specific things, and that comes into the cost of the premium that you're actually paying for. So those are the kind of things you've got to be aware of. There are so many movies.
No, but this is so great, Luke, because then we also come back, just be a conscious buyer. You know, the whole point we're saying 2 things that make you wealthy is be a wealthy spender and build up your assets. And this is about being wealthy spender, because if you understand that you understand that you're buying something and you know what you're getting, if you getting a bundled product when you don't actually need half of the things in the bundle, then you're going to be better off getting the non-accelerated, and you buy what you need, and then you're not parasiting off, because a lot of people buy these bundled products not understanding they're accelerated, and they think it's like it's the bells and whistles. Most of us do not need to be like cows walking around with bells around our neck, so don't buy the fucking bells.
You've mentioned something which I think is so important. And we see this a lot, especially as advisors, we complain about it. Because a client, and it's a terrible thing, client bought a product 10 years ago. And the client just continued to pay the premium and never saw their financial advisor. And then all of a sudden there's a claim. Now the financial advisor has received money on this, and there is a problem in regard to that. But what I'm driving at here is that as a purchaser, you've also got to be a responsible purchaser. Now what happens is, Natalie will buy a life cover and she won't look at that life cover for 5 years. And then all of a sudden something happens and she's like, yeah, but you never told me about this, or you never looked at this, or whatever. You have to participate in your own salvation. You actually have to participate in your life cover as well. You've got to participate in this, because what happens with a lot of investors or a lot of life cover, whatever, they buy the product with the intention of, oh, well, if something happens, or I'll see my insurance guy, or whatever it is. You have to make a point. You have to make a point of seeing your advisor at least once a year. You got to try and see that guy or that girl at least once a year, because the problem is that 9 times out of 10, when you want to see that person again, they're gone. They're gone. There's huge turnover in our industry. Okay. So you've got to make sure that you actually take responsibility for what life cover you've got and how it's busy working and the tweaking and stuff like that. Because, I mean, it's a terrible thing, but it'll make your financial advisor very excited that you're busy phoning him or her all the time. But the cool thing, then you know what's going on in your life cover. So I'm terrible. I'm one of those guys as well. I try my best to see my clients at least every 6 months. I try my best, but I normally only see them once a year. So I have to reach out. But I also say to a lot of my clients, if you need anything, engage with me, you know, because a lot of people think, well, I can't bug him, you know, I don't want to bug as much as you possibly can, because at the end of the day, it's your money, you paying for it. You want to know what's going on.
Absolutely. This is key. I love this. So Kerry is saying, so quick info, I'm not married, no kids, no debts, self-employed, and getting my shit together with what Anne teaches us. So this is really key. So hopefully, Kerry, you're really saying, okay, come in and price what you need. If you've got no dependents, no debts, yes, you are self-employed. So there's an aspect for you around maybe income, as you're building those sides, income protection, those sides. Then you do your first sweep of believing what you need, not what you want, not what are emotions coming. And it's for a good independent, I would say, well, let's look at the costing. What are those benefits? And I think it's just really important for all of us not to get hooked into, oh, well, we'll throw this in, you'll get this as well. But if you don't need it, and especially on these accelerated products, I'm very much about conscious buyers. Buy what you need, get a pricing, don't be afraid to ask endless questions. And if Luke's metaphor of the glasses and Archimedes principles doesn't work for you, to ask him for another fucking metaphor. Just keep going back and saying until you fully understand it is really key. Luke had no idea how we were going to speak about insurances for an hour. You see how we can, Luke?
Yes. And I love what you said, and I think that's for me, it's the key. It's the key about insurance. There is a need versus a want. When you're sold on the want, you're buying a Ferrari. You know, when you're sold on a need, you're buying a car with an engine that's getting you from point A to point B. And the weird thing is that both get you to your end destination, but one's going to cost you a lot more. So from that perspective, what I would do is, whenever you're buying insurance, whenever you're buying short-term, whatever, ask yourself, do I need this? Is this what I need? I'd rather have more money going to my investment.
And it's the difference of going into a supermarket with a shopping list and not hungry, and you get what you need for the meals, versus wandering in without a shopping list and really hungry, and then you wonder why you walk out with a trolley full of shit that you don't need. And so do the work up front, so when you're contacting an insurance broker, you're not going to them saying, hey, sell me something, what do I need? It's saying, this is where I'm at, this is my gap, this is what I'm needing, give me options around the costing to fill that need. And I think this is what we do, is we choose to be empowered and then not be embarrassed to ask endless questions. We hadn't, when we started off right at the beginning, we weren't yet on the Zoom. Luke says, and we're both sharing, as we get older, we ask more stupid questions because we realize we know a lot less than we thought. Your average teenager knows everything. And then as you get older, you know less, but you don't get hung up about seeming stupid, because the only stupid thing is not be prepared to ask endless questions until you are clear. Luke, this has been so great, fantastic session. And I love this. You wonder why you go home as a proud owner of the whole of aisle 3. I love that. Yes. When you go in not knowing what the hell you want. And I guess that happens in life insurance. And then people bitch and moan when they go, they've got 5 different insurance products. So Luke, we've got your contact details, but any sort of key thing going off? Judy says, as you get older with life cover increasing, how will this affect your premiums? That's quite a broad, open question, Judy. I think in there, it really depends on you. I think the key thing, what Luke was saying, and thank you for that distinction, because I think in different parts of the world, and certainly in the US and the UK, whole life tends to be more expensive because it's product. And there was a great distinction between the term versus the whole life, that you can cancel your whole life at any point. But I think the challenge is understanding then, if you're going to use a whole life product, but as a term, I guess the key point there is not then having your accelerated bundled products, because if you want to now cancel the whole life part, you might get a recosting of the other elements you need. So this is about being savvy.
Totally. And the weird thing also is that I know whenever you get a new plumber into your property, he'll tell you how crap the previous plumber was.
The electrician, it's amazing.
With insurance guys, I mean, the funny thing about this is that after this conversation, you guys might go and speak to your financial advisor and say, well, this is what the guy said. Please understand is that there's nothing hard and fast about insurance. There's lots of things you can do. It's very pliable and very malleable. So from that perspective, you want to have as many conversations with the individual that you're dealing with as you possibly can. And one of the other things that I'm a big advocate of, and is that Natalie hates it when I do this. I'm the type of guy that will stop and ask for directions. I also go for 3 opinions with doctors because I think that the one doctor might get it wrong.
You're just not a normal bloke. And,
no.
And you followed what your wife said when it came to your money.
Yeah, when mommy's happy, everyone's happy. Yeah. So from that perspective, is that I'm a firm believer in the fact that you actually have to check yourself before you wreck yourself. Just check what you've got and make sure that works for you.
No, I love that. And I think, this is about, if we understand a little bit, we're then not baffled and bullshitted. And if you start feeling overwhelmed, pull back, come back, reconnect in, ask questions of also the wealth builders, this community. And I think what's really key is that repricing. So Judy, absolutely. As you get older, if you wait for different elements, but when you understand what you're needing, the pricing is going to be based on whatever your situation is at a time. The repricing or the recosting, as Luke said, will take in different factors. So that's key. So Kerry Ann says, I changed my life down and my dread up, and I had to fight to keep all my cover. Don't be afraid to go a few rounds to keep it all. I love that. Well, and this is what I love. Hell yes. Push back and often, well done, Kerry Ann. That's key, because it's also an industry that knows that a little bit of shaming, a little bit of pushback, hey, you're a little bit stupid, you don't understand it, will get people just to collapse in and just go, no, this is not about my identity. It's not about my value. I don't need you to validate me. I need you to answer my question, which is really key. Fantastic, Carrie Ann. I love that. I love that. Well, thank you, Luke, for your time. And we'll share. So you can go a few rounds with Luke. He is great. And
Also, and from my perspective, if you have any questions or anything, and you're dealing with someone, by all means, please, I'd love to assist, and I won't take anything away from that individual. I'll say maybe what you want to do is ask these specific questions. It might be better. Thank you. And also thanks for everything that you do for us as well. I appreciate it.
Oh, absolute pleasure. And it's just so lovely to have a wealth builder in the tribe. You know, as a community, we've got an amazing community, as you said, and actually sharing the insider knowledge, because we're then talking with the same language. And huge love to your amazing Natalie too. Mwah. Tanya, Kerry Law, Carrie Ann, they're all saying huge thank you.
Sure, no problem. Thanks, guys.
Bye, everyone. Pardon? Cheers.
No, don't worry.